Here in this video, we will go over all of your Tesla stock news that you need to know. But I think most importantly, what in the hell is going on with Tesla and the broader markets? This is one of the most volatile markets we have seen in a very long time. But what's different now is there seems to be, on the surface, no rhyme or reason to why stocks are doing what they are doing. So we'll break down what we know, try to put this into context, and I will explain what I am doing personally. I do have some trades that I put on today. I think we can kind of get a grip on what's going on with our market. So I will share with you guys my idea of what could be coming next. If you guys want to see all of these specific trades that were put on today, check out the link down below in the description of this video. A lot of you guys may not know I am a father of two full-time, no days off. So if you hear my little guy in the background, it's because he's teething, probably gonna look like a rabbit pretty soon. He's getting the top two, none on the bottom yet. So he's definitely going through it. But I promise you, he's well taken care of. That's in fact why these videos sometimes come out at 4:30 or 4:15 now, because yeah, he needs a lot of attention. Let's start with your Tesla stock news, because there's honestly not much of it today. The Tesla Model Y has officially become Switzerland's best-selling car in 2023. Tesla has released a Cybertruck video. It's 57 seconds long, and some people are wondering whether or not it may be worth it to do some high-value advertising, like a Super Bowl commercial. It's about $15 million, though, for 60 seconds. Let me know if a Super Bowl commercial for the Cybertruck, in your opinion, would be worth it for Tesla. Personally, I think that's exactly the demographic that probably has no idea about the Cybertruck that could probably benefit from hearing or seeing all of this information. I mean, most people just really have little or limited knowledge on Teslas in general, let alone the Cybertruck. Even The Rock, Dwayne Johnson, did not know the Cybertruck. Let me know if that is worth it, if you would actually like to see Tesla do some Super Bowl advertising. Panasonic Energy still plans to build a third EV battery plant in the US, an executive told Nikkei Asia. This plant is expected to help supply Tesla. And here you can see EV prices are now near parity with ICE vehicles. Average transaction prices for internal combustion vehicles is $48,759. Tesla sits about $1,300 higher than that at $50,051, and the average EV slightly more than Tesla at $50,798. Although I do not believe this is pricing in the energy savings that you see via charging your vehicle at home compared to getting gasoline at the gas station. Typically, on average, people can save anywhere from $1,000 to $2,000 a year just in energy costs and fuelage costs by having an EV compared to filling up at the gas station. So I believe if you factor that in, it's actually cheaper to own a Tesla or an EV, and I think that's something that should also be advertised if Tesla does theoretically do a Super Bowl commercial. There are 70 new EVs, new models, coming in the next 2 years. As of right now, that could obviously change. We see this change all the time. Lots of promises that companies under-deliver for. But as of right now, we are expecting a lot of new models to be coming. That could be overall positive for the world and ultimately for Tesla. Some people might say, well, why is that? Why would that be positive for Tesla? Well, a lot of people just have fear about EVs in general. It's not that people want a Ford over a Tesla. I think everyone mostly would want a Tesla. It's people just don't see them a lot. They don't interact with EVs a lot. More EVs on the road will lead to more sales for Tesla overall. US battery storage capacity could increase by 89% by the end of 2024 if all planned energy storage systems are brought online at the targeted time, the Energy Information Administration said on Tuesday. Tesla's Google Trends data is showing a little bit of deceleration across the board. The Cybertruck now at 21, although this is incomplete partial data. The Tesla Model Y at 30 and the Model 3 at 33. You are seeing a little bit of a downturn here, but that's pretty typical to start a new year in Q1. It tends to be one of the weaker quarters for Tesla, really for all automobile sales in general. Global inventory numbers for the Tesla lineup show the Model Y continuing to trend higher. The Model X has recently jumped as well. The Model S is kind of trending downwards now, and the Model 3 is in a very low place with only about 880 in total inventory. Model 3 inventory around me is basically none. This has seen a little bit of a jump, about 150 jump from yesterday, but still likely a good sign there's some heavy demand for the Model 3. And Tesla continues to run 400 different ads with Google. Despite Tesla's stock being down about 2.5% today, option activity looks very strong under the surface from hedge funds and institutions. So far on the day today, final numbers will come out at 8:30 p.m. tonight, and it looks like it's going to be quite a big day. But right now, you have 528 orders totaling $607.37 million with a positive order value of 70%. That's strong. That's much better than the last week's positive order value as kind of an aggregate of 56%, about 14% greater positive option activity today from hedge funds and institutions. If you look at the overall numbers expiring by this Friday, you have calls on the open interest side of 55.1%, puts at 44.9%. If you look at the volume, that is 57.78% today to the call side, 42.22% today to the put side. So definitely some very encouraging option activity. You always want to look under the surface what big money is doing and not as much to what the stock is actually doing. This will make more sense as we go on throughout this video, and especially as we talk about what's going on in our broader markets. Here on the day today, Tesla's short interest has increased, at least the dollar amount that is currently sold short has increased to $20.41 billion. Tesla remains the most heavily shorted stock on Wall Street, accounting for about 2% of the entire stock market's short interest. That's why good news is really good news for Tesla. And in the broader markets, good CPI report, positive Fed tends to be very positive for Tesla, and vice versa. When things are bad, it tends to be really bad for Tesla as well. Now let's discuss more in depth what in the hell is going on with Tesla stock and the broader markets. See, what's happening recently with Tesla, it really has nothing to do with Tesla specifically. Tesla beat on deliveries. The day that Tesla announced deliveries, the markets were down, and Tesla stock did much better than the broader markets. But that still doesn't take away from the fact if the markets go down or go up, it doesn't matter as much about what Tesla is doing. Tesla stock tends to trade more on what the markets are doing. And what have the markets been doing in 2024? Well, selling off. Yesterday was the first good day we have had in a while. Tesla stock was basically in line with the markets. Tesla stock went up 1.25% yesterday. But what's really going on under the surface is there's a lot of profits in the last 60 days of 2023. Stocks gave you like 2 years worth of returns. So people have been taking those profits, saying, hey, it's better to sell now with a profit and ask questions later. Whether we should be in stocks, out of stocks, recession, no recession, 6 rate cuts, 5 rate cuts, 2 rate cuts, 3 rate cuts, you get the idea. It's typically better after coming off a very large rally to sell first, ask questions later. That's what's so interesting about our markets. These moves that we're seeing really have no rhyme or reason to them. If you take a look at IWM today, IWM is down 0.75%. This is the ETF that tracks the Russell 2000, your small cap names. There's really no rhyme or reason to what's going on here today with IWM. It's a sell first, ask questions later kind of market. Now you have to ask yourself, here in the near term, what does that mean? Well, that means we're waiting for clarity. Now, it's pretty clear to me that the overall narrative we want to be watching for is the economy strong? Is inflation falling? And then secondary, how many rate cuts do we get? Because obviously, if the economy gets worse, we're going to get more rate cuts. If inflation falls, we're going to get more rate cuts. But if the economy gets worse and more rate cuts, that's not going to be a good thing. But the best potential outcome is the economy holds up, inflation falls faster than we're expecting. That leads to more rate cuts. That's your Goldilocks-like scenario. That is your soft landing. Unfortunately, we do not get our CPI report until Thursday. So tomorrow is going to be another very wonky, weird, volatile day, and we really don't have much for economic data or anything that's really going to move our markets. Tomorrow, we are only going to get a 10-year bond auction at 1 p.m. Eastern Standard Time, and Fed Williams that speaks at 3:15 p.m. This 10-year Treasury auction could give the markets a move because it's based on where markets expect Fed policy will be in 10 years, where the economy will be. So there can be things implied by bond auctions, and we have seen bond auctions affect the markets quite big over the past 3 months or so, but that's really it. Here in our markets recently, we've also gotten quite a few of Fed speakers that are vouching for less rate cuts, and rate cuts not coming until later in the year. Right now, markets are pricing in about a 59% probability we get the first rate cut in March. Now, the Fed right now is trying to jawbone the markets. They're trying to talk the markets out of a March rate cut. The markets, on the other hand, still pricing in a Fed rate cut. And typically, the Fed follows whatever the markets are pricing in. So I think coming on January 31st, if we're not pricing in the rate cut until May or June, Fed Jerome Powell is probably going to be pretty hawkish. So I think that's a couple weeks away, obviously, before we get Powell that could hawk down on expectations for rate cuts. So that's something we want to watch. So believe it or not, you've actually seen the odds of a rate cut in March falling recently for good reason. I mean, Fed Bostic yesterday said he only thinks the Fed's going to cut rates twice next year. That's lower than the 3 rate cuts the Fed was projecting just in December, and he thinks the economy is going to hold up better than expected. Net, I would rather see 2 rate cuts and a strong economy, and I think that would be better for stocks. So ultimately, net, that's a positive. But here, what we're seeing right now, at least today and over the past couple of days, the odds of a rate cut in March have been falling. Some sectors of our markets have been getting used to the idea of 6 rate cuts. This has been putting some downside pressure on stocks recently, but I think as we get closer to officially unpricing in a rate cut in March, it makes the next couple of weeks potentially much better. Then Powell might not have to come out on January 31st and hawk down on the markets if we start to price in the rate cut in May. Currently, we are pricing in a rate cut in March and a rate cut in May, but we're getting pretty close. There's 40.7% odds of just 1 rate cut by May. So it's getting better. 51.5% chance of 2 rate cuts by May. This is something I'm personally watching. The higher our markets can stay, but without seeing a large down move, and the more we unprice these rate cuts, especially for March, and start to price in the first rate cut in May, that's a positive thing for the month of January and the month of February. Because again, then the Fed won't need to hawk down on rate cut expectations and potentially crash the markets on January 31st if we no longer price in a rate cut in March. The other thing the markets are getting ready for is earnings season. Now, earnings season is going to kick off with the big banks. You're going to get Citi, BNY Mellon, BlackRock, Wells Fargo, Bank of America, Delta Airlines, United Health Group, one of the largest components of the Dow, by the way, and JP Morgan reporting earnings Friday in pre-market. Now, expectations for earnings growth in 2024 is 11%. That is high in any year. That's very high for just a normal year or a strong economy. There's some questions here. Are we going into a recession? Is the economy actually accelerating? Where should expectations be for S&P 500 EPS growth? Right now it's 11%. Again, that's very high. So you are, again, getting some let's sell first, ask questions later, since a lot of stocks have done well. So if you start to see companies report bad earnings, well, that's also something that's really not priced into our markets, at least on the top line basis. That's because a lot of your FANG stocks or Magnificent Seven stocks have a lot of the earnings power in our markets, and they have very high PEs. So actually, under the surface, some of your small caps, some of your interest rate sensitive names that have been destroyed over the past 2 years that really haven't done much of anything. Think of Tesla, PayPal, Fubo, SoFi. Those names are actually expected to do even worse than 11%. It's obviously on a stock by stock basis, but point is the broader markets could be in trouble if earnings come out bad. Now, good news is we're going to get Tesla earnings on January 24th. Those are probably going to come in okay, probably going to come in pretty good. And then you're going to have earnings after that of more big tech names. So from now until January 24th, the markets are really up in the air. And the big move that I expect to come is from CPI on Thursday. Now, CPI on Thursday has very high expectations as well. Goldman Sachs have already came out with their estimates. They think CPI is going to fall more than expected. Now, core inflation is actually expected to fall from 0.3% last month to 0.2%. Core inflation year over year is expected to fall from 4% to 3.9%. I think core month over month actually has a decent chance of coming in at 0.1. That's just my personal opinion. Obviously, there's a rounding measure that also takes place here. So technically, core would have to come in lower than 1 point or 0.14 to be rounded down to 0.1, or if it comes in at 0.5 or higher, or 0.15 or higher, then it'll be rounded to 0.2%. Hopefully that makes some sense. So under the surface will actually be important with this CPI report as well to see if we're actually getting that deceleration of inflation or if we are not. Now, your month over month, your headline is expected to increase from 0.1% last month to 0.2%. I think the markets will largely look past any rise that we may or may not see in headline inflation, because that's driven by really energy prices that have went higher, that have started to go back down here in 2024. Now, year over year, CPI is expected at 3.2%. Last month, we were at 3.1%. Preferably, you want to come in at 3% or lower. A 2.9% rating would be fantastic for year over year CPI. So when I look at this collectively, I think inflation is going to come in better than expected. Now, that can lead to, in the short term, a rally in the IWM and small cap stocks, really in the broader markets, until we get earnings. Because if CPI comes in lower than expected, as we just mentioned, that means no matter what the economy does, let's imagine the economy stays strong. If CPI continues to fall at faster paces than what the Fed is expecting, that means we'll get more rate cuts with a strong economy. That means a soft landing. Now, if inflation were to reaccelerate somehow in December and that number comes in high, these CPI numbers, that's going to be a big problem for markets. Big problem. And stocks are going to fall quite a bit. So I think right now there's a lot of jitters on what could happen, what's going to happen, how that could affect our markets. And when stocks, broadly speaking, the indexes like the SPY, trading at almost all-time highs and not adjusting for dividends, with dividends included, you're trading at all-time highs right now, or at least you did hit new all-time highs at the end of 2023. I mean, with all of these gains recently, a lot of funds don't want to take the chance. And that's really simply what is going on right now. It's not really anything that happened today that is substantial that caused stocks to fall. Even if you look at 10-year treasury yields, they're up nominally, like 1.5 basis points. That's nothing compared to what we have even seen recently. Now, 10-year treasuries were at about 4.05% in the beginning of trading today. They have actually fallen throughout the trading day, and that's partly why stocks are not trading at the intraday lows, at least at the time of recording this video. That could change in the next 20 or 30 minutes or so. But you're really not seeing much happening. If you take a look here at the dollar, we'll go ahead and refresh this just so we do have the correct numbers. The dollar is up 1/3 of 1% today. That's not great. Typically when the dollar is up, stocks are down. So that's, not fantastic. USO is up 1.39%. That's also not fantastic. Gold is pretty much flat on the day today, and TLT is down about 0.58%. So none of these things are great, but it really all has to do with the sell first, ask questions later mentality. There's no data, there's no rhyme or reason why the dollar is up today, oil is up today, and gold is trading flat. So when I put all of this together, what is the bottom line? People are a little bit fearful right now. There's a lot of uncertainty up in the air, specifically whether inflation is continuing to fall at a fast degree, or if inflation is going to reaccelerate, and or are we heading into a recession? Ultimately, I think inflation fell faster than expected in December. Thus, I think a shorter term rally, and a pretty aggressive one, could be coming to interest rate sensitive names. Interest rate sensitive names are the ones that really benefit when inflation falls faster than expected. That includes Tesla. Now, Tesla here on the day today is sitting at $235.11 at the time of recording this video. So you are now under your 50-day moving average. That is not great. You're sitting at the lower end of the demand zone, as you can see in the beginning of the day today. Tesla stock hit as low as $232, and you bounced. You see a lot of wicks down here in this range. You tend to bounce in the low 230s. Now, for whatever reason, if inflation comes out bad on Thursday, Tesla stock could get wrecked. The markets could get wrecked. And specifically Tesla, if you break under this 230 demand zone, I mean, you're heading back to the 220s. Now, that's where things get a little bit more interesting, is because your 200-day moving average is at $230.79. So I think there's going to be a lot of support around 230. But if you break under that, things get ugly here. I think the risk to reward highly favors an upside move for Tesla stock, especially after today's 2.33% decline. Now, to the upside, you want to be watching about 240. That's a lot of resistance, proven resistance. If you get above 240, that's where more upside looks likely. But I think we have to get through Tesla's earnings on January 24th, and we definitely want to get through earnings, at least through Apple, which I believe Apple reports earnings on February 1st. Don't quote me on that. I don't think they have officially confirmed the date in which they will report earnings. But if they do report earnings that are okay, if Apple, Microsoft, Google, Amazon, Tesla, and Netflix, Nvidia is going to be later on. But if those other stocks report decent earnings, I think the markets stabilize and likely head higher from here, as long as inflation did fall more than expected in December. Tesla, more on a technical basis, if you look at the RSI, the relative strength index, Tesla is on the oversold side at 42.18. Usually there's a reason if Tesla stock goes oversold or gets oversold. Right now, there's nothing specifically with Tesla that is causing that. The MACD also looks pretty negative here. So markets are interesting. Markets can get over bad news very quickly as long as it don't continue to get bad. So as long as things don't continue to get worse from here, Tesla stock is likely to bottom out and to head higher, at least in the very near term. But I do think it's possible at some point, maybe in Q2 after March, that you do get a little bit more weakness in stocks, especially if we get a rally towards the highs and, small caps do recover. Tesla, let's say Tesla goes to like $300 by then. You could be in for a pullback around the second quarter or so if we do start to get some weaker economic data. So that's kind of what I'm looking at right now. I have a very near-term position on IWM calls. That's the Russell 2000. And I do have a longer-term short on Apple. So that's kind of how I'm playing this. That's not financial advice. You could lose all of your money if you listen to me. If you trade anything based on anything I say, that's never going to be a good idea. That's kind of where I'm leaning as of right now. So let me know what you think about all of this information. Why are stocks falling? Why is Tesla stock down over 2% here on the day today? And what is your expectations for CPI coming out on Thursday? Thank you for watching. Enjoy the rest of your day. My name is Michael Tyler, and I will see you in the next one.